Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 doing my first 5 minutes of due diligence. So we are looking today at Agilent Technologies, ticker A. This is probably my favorite ticker ever, just a single letter. So ticker A on the New York Stock Exchange. So my first 5 minutes of due diligence. Let's dive right on in, figure out what this company's worth and whether it's worth buying. So the first thing we look at is industry, life sciences, tools, and services. I don't really know what that means, so let's see what the description says. Solutions, life sciences, diagnostics, applied chemical markets, liquid and gas chromatography systems and components, mass spectrometry systems. So this looks like diagnostic equipment, analyzers, flow cytometers, cell imaging. So they provide arrays for DNA mutation, gene editing, gene arrangements, GCLC. So this looks like chemistry and lab equipment. I don't know clearly on this if they're doing the testing themselves or they're just producing the equipment, but it says application focused solutions. So we'd need to learn more about where exactly they're setting themselves up. Beta 1.04, pretty normal for S&P 500 company, doesn't really tell us anything. Share turnover 144%, not a super stable base of shareholders when it's over 100% turnover in a year. So let's see, return on invested capital. We're going to ignore this spike in 2006. It's probably an accounting weirdness. So this looks very stable. Let's see what these numbers are. So they lost money in 02 and 03, 04. They had 8, 05, 7%. Then it was 12%, 13%. They lost money in 2009. Then it was 11, 15, 16, 9, 7, 6, 7, 10. So it's not super stable. It's just because this is looking messed up here. So you have quite a few years above 10%, but some in that 6% range. Okay, if they use debt and leverage, this could work out to a reasonable return. They don't really have any years losing money besides 2009. So if you ignore, basically since 2004, only lost money in 1 year, that's a good. I like this setup. I would like the returns to be a little higher, but they've been high enough recently. 10-year median returns, return on assets 7.2%, return on equity 14.5%. So again, this is kind of showing they're using leverage to hit your target returns on equity. I like to see 15%. You're in that ballpark, and you're probably leveraging up to get from this 9% to the 14%. Not super stable though. Price to PE is 35, seems really expensive. Doesn't seem like it's a one-time issue though, because price to sales in 6.7 is pretty high, especially when you compare to your margins. Your margins aren't gigantic. They're really nice. Gross profit of 52% is good. But again, we need to see what the stability is like here. So gross margins, very stable. This means there's probably a competitive advantage here. So you have 52%, 49, 48, 50, 52, 53, 54, 54, 54, 53. So what we're seeing is there's very little change. You had a dip in 2013 and 2014, but by 2016 you were back in the 52 to 54% range. I like those stable gross margins. The operating margin seems to have grown across the decade. We're now up to 21%. But not as stable, so it's harder to see what's going on here. At this PE ratio of 35, you want to see very fast growth. Some of my metrics I like to hit is I'd like to hit a PE of 10 within the next 3 to 5 years of owning the company. And so to do that at 35 PE, I need to be growing like 30%, 50% a year. But when you look at the 10-year revenue CAGR, it's negative. So they aren't having more revenue today than they did 10 years ago. That's bad. Assets 1%, earnings per share only going up 3% a year. This company looks incredibly overvalued. Let's see if there's anything else we can tell from the income statement. Is there anything funky going on? No, not only is revenue flat, but gross profits flat at 3.6 billion to 3.4 billion. So it's actually a little lower than it was a decade ago. Operating profit basically flat from 1 billion to 1 billion. What is their market cap? 42 billion market cap, and they're earning only $1 billion in market. So you're basically paying 40 times operating profit. This is way too expensive for a business that's not growing. So they've been buying back shares. That's the only good thing I've seen in this company. They've gone from 348 million shares to 304 million shares. That's good. They've been buying them back consistently. Cash flow is not much better than the earnings. So your cash flow from operations is like 1.4 million, and they're having to invest a lot of that back into PP&E and acquisitions. This is just an uninvestable company at these prices. I would maybe consider a company like this at or below book value because they're not earning even their cost of capital with a 10% rate of return. And you need to pay a PE of like 8 to justify a business not growing. So Agilent Technologies is a pass for me, even though I would have thought this is a good industry with these gross margins and stability. Thank you for listening. Don't forget to like this video and subscribe. Hit that bell button when you subscribe in order to get notifications when new videos come out. Thank you.